The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service Advanced Technical Analysis course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
So momentum indicators, what are they? They are simply a mathematical derivative of price action. Oscillators, as I mentioned earlier, are interpreted in similar ways. Their primary goal is to measure the internal strength of a trend. Essentially, what we are looking for from a trend perspective is a situation where price and momentum are moving in the same direction. So if price and momentum is rising, then the trend is positive. That is seen as a technically strong condition. If price and momentum is falling or moving in a downward direction, the trend is negative or bearish and therefore equally technically strong. Bullish divergence is a situation where momentum fails to match a move lower in price action. In other words, we have a situation where we do not see a move lower in price action as well as a move lower in the momentum oscillator. They are beginning to diverge in direction. This is an indication of a loss of downward momentum, or to consider mentioning it another way, bearish momentum is waning, and this is seen as a technically weak condition. Bearish divergence is a situation where momentum fails to match price gains. In other words, the trend has been moving up, price action continues to move up, but our observation for momentum is that it's beginning to move in a downward direction. In other words, it's diverging from the direction in price. This is an indication that bullish momentum is waning, and it is a technically weak condition. We'll look at all of these concepts over the next few minutes. It's important to remember too that momentum simply provides a warning of a possible condition. Now, why we're stressing this particular point is because at no point will we suggest that it is a good idea to take a trading decision based on what you see in momentum. It's important that you take on board the observation in momentum as a warning sign and then go back to price action to see when price will confirm, or if it does indeed confirm that warning sign in momentum. Take a look at this concept too very shortly. Finally, as an extension of what we just mentioned, price is the only indicator that will confirm the condition in momentum. Once price has confirmed the condition in momentum, we can then consider taking on board a trading strategy. So this condition is required before trading a particular signal. Popular indicators that are used, and the two that we will focus in terms of applying in the illustrations, are the relative strength index and the stochastic oscillator. The purpose of this webinar, simply or principally because of time constraints, is not to show you how these indicators are calculated. This information can very easily be discovered on the internet. If you just do a simple search, you'll be able to see what the underlying calculation is behind the relative strength index as well as the stochastic oscillator. What we are going to focus our attention on, because this is really what you need to understand about momentum oscillators, are the most common applications, and these are overbought, oversold readings, divergence between price and momentum, and the combination of these two factors, which we will look at later too. What is overbought and oversold? Simply, and in a nutshell, they refer to the extreme values in the oscillator. If we were applying a relative strength index, the reading in the relative strength index is a percentage value. Typically, and this is a default reading, is that anything above 70% is regarded as overbought, and anything below 30% is regarded as oversold. If we were using or applying a stochastic oscillator, the threshold is slightly higher. 80% reflects overbought, 20% reflects oversold. Now, what we will look at a little later is how we can extract and use this information to our advantage. What these overbought and oversold readings are not saying is that the market cannot continue to move higher if it's overbought or cannot continue to move lower if it is oversold. It is simply an observation of what the underlying conditions are with respect to, or at least potentially with respect to, the internal strength of a trend. So you may say to yourself, okay, if a trend has been moving up for some time now, and we look at the momentum oscillator and it is overbought, we may say, while we recognize the fact that price action can continue to move higher, we will now also be on the lookout of any signs that suggest an inability to move higher, because we have observed the market to be in what we would typically term in technical analysis language, the market is now in overbought territory. So that would be a very typical conclusion as an illustration as to how we would take on board initially any overbought or oversold readings. What's important to be able to understand, and this will be one of the really key pieces of information you can extract when applying overbought and oversold readings, is the effectiveness of these two readings. They are a function, or their level of effectiveness is a function of the underlying dominant trend. In an uptrend, oversold levels are more important than overbought readings. In a downtrend, it is the reverse. Overbought levels are more important than oversold readings. Because essentially, if we remember one of the statements that we made earlier, a strong trend is a situation where both price and momentum are moving in the same direction. Therefore, if we were looking at a downtrend as an example, there's a greater probability that momentum has the capacity to move in a downward direction from an overbought level rather than an oversold level, because at the oversold portion, it is closer towards its lower extreme. And we will take a look at how we can really fine-tune this decision very shortly. So, to conclude then from the above statements, before applying overbought and oversold readings, it's very important that you establish the direction of the trend. And this goes along, well, this is a statement that is repeated over and over again, no matter what application you apply to the market. You need to establish the direction of the trend first. So here we have an illustration of a situation where the trend is very clearly moving in an upward direction. Remember what we discussed with momentum and price. If we are to see a technically strong, in this instance, an uptrend, we need to see price moving in an upward direction. And we also need to see momentum moving in an upward direction. Those phases, those portions of the move higher, will reflect a strong trending environment. Now, in the bottom section of the chart, you can see a relative strength index in terms of its appearance. We've simply used a 14-day relative strength index. This is a default reading for the relative strength index. What you can gauge from initially is that the relative strength index oscillates from one lower extreme to the other upper extreme end. The top section above 70% is overbought. The lower section below 30% is oversold. What we've illustrated on this particular chart are a number of instances where the relative strength index is below 30%. In other words, it's oversold. You can see in each instance, the market very soon after having arrived at oversold territory begins to once again establish the uptrend. This makes absolute sense because the trend is moving in an upward motion. Therefore, for us to be in a situation where we have both momentum rising as well as price action rising, the greater chance of that occurring at a fresh start, so to speak, is from an oversold end of the spectrum when we're looking at this particular oscillator. What I've also highlighted in this chart are certain instances where the market is overbought to illustrate the fact that in an uptrend, overbought readings are less effective than oversold readings. You can see how price action or the momentum oscillator in this particular instance, if we just extend a vertical line up from here, the momentum oscillator is moving down, yet we still see price action continuing to move in an upward direction. This makes absolute sense because if we are dealing in an uptrend, demand is outstripping supply. Therefore, there needs to be an overall stronger interest to continue pushing prices higher or to continue buying, which ultimately have the effect of pushing prices higher. That then means that the overbought condition is going to be less of an issue to the market in terms of taking profit, whereas the oversold readings would reflect an opportunity to buy once again. If you were a trader and you were considering buying at this particular level, only to then wait a couple of weeks, and then you see price action down at this particular level and you still believe it's going up, well then this should in theory offer a better enticing or a more enticing entry level for you to consider looking to go long in this particular market. And that is why the oversold readings are stronger in a downtrend, and likewise they'll be less, or the overbought readings will be much stronger in an uptrend. This is really important to understand when we are dealing with the overall effectiveness of overbought and oversold. What is bullish divergence and bearish divergence between price and momentum? What we can see, at least initially, with respect to the chart that you have in front of you, is that initially the trend is clearly up. Here we notice that the market, compare this high to that high, the market generates a new high in the uptrend. However, from roughly this point over here, we can see that the momentum oscillator is beginning to generate lower peaks. Therefore, it is beginning to highlight at least a directional move that is in an opposite direction, i.e. down, to the direction in price. This is known as bearish divergence in price. In other words, price has generated a new high and the momentum oscillator has failed to generate a new low, rather a new high in its overall cycle. That means that this trend is beginning to develop conditions that warn of perhaps some technically weak elements entering the trend. At some point in time, we are likely to see a reversal. As we stressed earlier, this condition in momentum is simply a warning sign. Price will confirm a reversal and therefore confirm the initial warning sign in the momentum oscillator. So, bearish divergence is a situation where in a rising market, new price highs are not matched by new highs in the momentum oscillator. Bullish divergence will simply be the opposite condition. It's important to note and remember that divergence between price and momentum warns of some degree of vulnerability that is building up in the existing trend. Since momentum measures the difference between closes and is a derivative of price action, we'll stress this point again, it simply is just a warning sign. Price needs to confirm this potential warning. In this example that we have in front of us, that warning sign begins to develop at roughly this point in price action. We see how prices continue to move higher. If we are using this trend line, for example, as a key gauge of the uptrend, we could say to ourselves, if price action does break the trend line, then that will be conclusive evidence that the trend is reversed, and therefore it will confirm the developing bearish divergence between price and momentum. So we need to always go back to price to identify where and if the reversal does indeed take place that perhaps could have been preempted as a warning sign by the developments in the relative strength index. If alternatively, price action at the top of this chart in front of you is a head and shoulders reversal, then the break of the neckline, as we saw yesterday, would confirm a reversal in trend, reinforcing or rather confirming the condition in the momentum oscillator. So always go back to price to identify and determine what you are dealing with. In this example, we will combine an oversold reading together with divergence in price action. What you can clearly see is that we've had a downtrend, very clear directional downtrend. Your first observation in price is that the market has changed in terms of its character. It's gone from down to sideways. What we mentioned earlier, and we stressed last week, is that when you observe a change in the nature of the way price action is behaving, that potentially is an early warning sign of a change in market sentiment. What we can identify from this price action, if you recall from your pattern analysis yesterday, is a possible developing double bottom. We can draw across the midpoint, our midpoint line, and we know that if price action breaks that level, that will then confirm a shift in direction in the trend from down to up. So that is our observation, a double bottom in this example. If we have our momentum oscillator below, we've identified our overbought and our oversold territory, we can see that since this area over here, the momentum oscillator has gradually been moving in an upward direction. Therefore, what we have been observing is a developing bullish divergence between price and momentum. We will go back to our study of price action to see whether there is any weak conditions developing with respect to the prior dominant downtrend. The observation of the double top highlights that potential change in market sentiment. The confirmation of the double bottom is our cue then to start considering long positions in this particular market, because the reversal has indeed taken place. The pattern is confirmed, and the fact that the pattern is confirmed also confirms this developing warning sign that we had been monitoring in the momentum oscillator. So this is a very good example of using the momentum oscillator and then extracting the price information to make a decision as to what conditions in terms of trend you're actually dealing with. Bullish and bearish divergence is seen or regarded as a stronger reading if the divergence also occurs from either the overbought, the oversold in this instance, or the overbought territory. Because we've moved from one extreme, overbought, down to oversold, and then the market is beginning, or the oscillator is beginning to diverge from price action. So that is a consideration in terms of how we can combine both overbought, oversold, and apply the divergence between price and momentum if this does develop. Trend lines, patterns, and finally our discussion of time in momentum. We'll look initially at trend lines and patterns. Momentum oscillators can be treated in the same way price is treated. In other words, you can apply trend lines to your momentum indicators, look at the trend line breaks. These are effective applications when you are using indicators or oscillators in conjunction with your analysis on price. You can also identify price patterns such as head and shoulders, for example, or double tops in the momentum oscillator. Time is a very important component when it comes to using divergence in momentum. It's very important to remember that the divergence that exists between price and momentum can occur for long periods of time before that has been confirmed. This just simply further reinforces why we need to ultimately wait for price to confirm a reversal in trend rather than look to preempt that condition through the momentum oscillator. And we'll look at one example before we conclude today's webinar. Therefore, you can consider using your momentum oscillators in much the same way as your price from an analytical perspective. Here's an illustration whereby we just simply highlighted using and drawing trend lines on your momentum oscillators and using the break of the trend lines to suggest, or at least take on board the confirmation that the oscillator is moving in a downward direction. You can then observe that we've broken a trend line, and those two developments would give you greater confidence that it is potentially then worth considering trading this portion of the decline. In the same manner, we see the trend line breached in the momentum oscillator over here, and then price action begins to develop a bullish recovery. We can also apply the same kind of logic with respect to price patterns. Here we can see an identification of a double top at an overbought reading, and perhaps even a wedge, which in this instance sees the oscillator move lower from its overbought extreme. These developments, in terms of the more traditional uses of technical analysis on the momentum oscillator, are also potentially more effective or more significant when prices have moved from or are moving out of their previous extreme condition. In other words, from an overbought reading or an oversold level. For example, over here, we have the break lower, where the market prior to breaking lower was in overbought territory. Finally, the concept of divergence in time. We mentioned earlier that it's important to remember that when either bullish or bearish divergence does develop, this condition can extend for a long period of time. You can see in this chart, and the fact that this is a weekly chart really emphasizes why we need to wait for price action. From this vertical line over here, prices continue to move in an upward direction. However, we can see how at various intervals the momentum oscillator is clearly establishing a downward trend. That simply tells you that while prices can continue to move in an upward direction, the developing bearish divergence between price and momentum in this particular instance is suggesting that as prices move higher, this trend is becoming technically weak. However, we will not look to preempt anything. We need to wait for some level of confirmation from price action that yes, indeed, the trend has reversed. If we're using a trend line, as we are in this particular example, we can see that the trend line is finally breached over here, ultimately resulting in some choppy activity and a move down to this particular level before the trend once again resumes up. What we are not saying is the type of reversal that will take place. Price action or some degree of price action will give us perhaps an indication of that. We are first and foremost identifying when price action provides the confirmation of a change in sentiment. That then confirms the developing condition that we've been monitoring in the momentum oscillator. In this instance, there was a change in sentiment, but it just really resulted in an extended pause in the uptrend, some very choppy activity before the market ultimately started to push higher. In other instances, this confirmation of a trendline break will ultimately lead to a much greater reversal or much more significant reversal in price action and establish or see a price action establish a sustainable downtrend over a period of time. In both instances, we need to wait for price to confirm the developing warning sign in the momentum oscillator. That then concludes today's webinar. We looked at momentum oscillators and moving averages. We started our discussion by showing you how you could use and apply moving averages. Firstly, by considering the application of multiple moving averages, and then we looked at the moving average slope. We also discussed very briefly the idea behind moving averages and support and resistance, as well as why moving averages will always lag prices. We then moved on to discussing and introducing to you momentum indicators, focused our attention on overbought and oversold. More importantly, perhaps, when is overbought and oversold more effective? We considered bullish and bearish divergence and the idea of combining overbought, oversold readings as well as divergence. We then suggested that one could use more traditional aspects when applying momentum oscillators in terms of actually analyzing those oscillators and their movements by using trend lines and patterns in momentum. And then finally, an important point to take on board in terms of the amount of time that divergence can exist. Remember, whether you're using moving averages or whether you're using momentum oscillators or whether you're using both, you always need to go back to your price action to determine when the change in market sentiment actually does occur. It is very dangerous simply to act on the oscillators or the average without doing an overall check on price. In the next webinar, which will be tomorrow, we will revisit some components about the trend, really focus on understanding a trend, stress the point that the trend is your friend and that it is always important to trade in the direction of the trend. We will then bring part of today's discussion, the slope of the moving average, and apply that to trend definition. We will then also bring into the discussion some of the topics that we looked at today with respect to momentum and illustrate how you could use momentum to improve the timing element of your trade. We'll show you how these concepts can also be brought together to facilitate a more efficient approach to risk management, as well as timing a trade and then managing that actual risk. Over the course of tomorrow's webinar, we'll be looking at a number of applications. Tomorrow's webinar will certainly be quite different because it will look at taking some of the components and actually illustrate how you can build a specific trading strategy around these tools and techniques. Congratulations, everyone. We've completed, or you rather have completed, webinar 6 of the Advanced Technical Analysis course. We've completed today's webinar, which focused on applying momentum and moving average analysis. We'll be back tomorrow. Hopefully you can join us then. So thank you to conclude today for joining us, and we look forward to seeing you next time. Bye for now.